Today we're talking about something that's near and dear to my heart, and that's dividend power. But what is dividend power? Dividend power is just the ability of a stock to have a high yield, a high payout ratio, and a low debt. You want to make sure you have all three of those. Now, how do you actually pick high dividend yield stocks? What does that look like, and what is dividend power? So on top of walking you through how to actually calculate that, I'm going to show you some calculators you can use, and then we're going to walk through a portfolio that I've created that's called Dividend Power that has a list of stocks that encumber all three of those products or those principles I talked about a minute ago. But first, what is a dividend yield? You've heard me talk about this on the channel before, and I've talked about how you want to have a high dividend yield, you want to have a low expense ratio, and you want to have low debt if possible. Of course, that's not always possible, and there could be a stock or an ETF that's good that doesn't encompass those. But if you're looking for yield from a dividend from a stock, you'll want to stay tuned. So the dividend yield is nothing more than taking a company's dividend payment per share and dividing it by the stock price. So in this case, the S&P 500 is about 1.7%. So for every $1,000, you'll make $170 in dividends. If you're considering investing in dividends, you'll want to continue to pay attention. You also want to look at the dividend track record. So like it says here, history doesn't always predict the future, but if a company over the last, say, 40 or 50 years has increased their dividend track record in terms of how much they're paying, the yield is going up, their debt's going down, and their payout ratio is going up, that's something you'll want to pay attention to. So look at the track record. The next one is what I talked about a minute ago, is the payout ratio. So this is nothing more than the cumulative dividend payments by a company's net income in the same period. So if a company makes 100 million and they pay out 75 million in dividends, the payout ratio is 75. And before you ask, yes, you can have a dividend ratio of over 100%, and I'll talk about that later. Typically, there are industry expectations. REITs are required to distribute at least 90% of their income to maintain their tax status. That's something you need to be aware of if you are investing in REITs. Understand where the dividends play into, how those are taxed, and what that looks like. I will not be talking about REITs today, though. Dividend payout is usually a good indication of how sustainable a dividend is. So if you see a payout ratio of 10%, then 15, then 17, then 20, but then it somehow goes down to 5, that's something you're really going to want to pay attention to, as the company could be in trouble, there could be some issues, and it's something you want to take heed of. Now, return on capital invested. This measures how well a company can use the resources that it has to generate profits. So it's a calculation of net operating profit after tax divided by invested capital, which is really debt plus equity and any cash generated from financing. ROIC, all things being equal, a higher ROIC is better. So if a company is able to generate higher profits at a higher profit margin, that's typically better. So if a company has 90% margin over a company that has 95, all things considered, the company with 95 is going to be a more sustainable and suitable method for you to invest in with a potential higher long-term profit. Now, if you're looking to invest for income, that's something where just stocks, if you're just looking for income, this is, again, where something where just stocks may not be appropriate. ETFs could, or could be a combination of both. Now, this article in particular goes over some stocks, and we actually look at the yield. So these are stocks that are not in my portfolio, but I did like this article, and I will make sure I link it down below. Some of the safe high yielding stocks they put in here is Coterra Energy, Diamondback, Dow, Best Buy, HP, Regions, and KeyCorp, which is KeyBank. The yield here and the payout ratio, again, two very important things. So in this case, Coterra Energy, 6.5%, meaning they're paying out 6.5%, and that'll translate over to earnings per share, 6.5% of what you have invested, and that's over a yearly time frame. So if you have $100 invested, $6.50 when it comes to percent, and then the payout ratio. So if they bring in 100 million, they're paying out 20 million of that are in dividends. Same thing with Best Buy, although again, I probably wouldn't invest in Best Buy if you've been paying attention over the last 20 years. But if you are looking for somewhat of a higher yield, and they do have the actual highest payout ratio, meaning if they take in 5 billion in revenue, they're paying out half that in dividends. I'm going to move over here into actually what my portfolio looks like, and I'll make sure I copy this down as well for anyone to look at who's interested. But this is not a cumulative list, but this is a list that I put together that holds stocks that have, number one, a high payout ratio, a high dividend, and low debt. Now, this list is not exhaustive. I'm not going to go into all these, but if I look at one of these, I'm going to stack these by alphabetical. AbbVie, they have their next payout. They actually announced a cash dividend of $1.48 per share with the next ex-dividend date of October 12th, which is next month. If you look at their forward annual dividend rate, it's 5.92. If you looked at their trailing annual dividend, it's 3.78. Their price to book is fairly low. And by the way, these are all stocks that have a 40-year time horizon of continuing to expand on their dividends while keeping their debt low and a payout ratio typically above 10 to 15%. That's where I came up with this list. So again, if somebody wants to import this and look at it and invest, have at it. This is all free of charge. I want everyone to learn from this. Because again, if you are looking to add some dividend power to your portfolio and you want to start bringing that money in every month or every quarter, this is a place to look. On the bright side, these dividends are paid out every quarter. So if you're looking again for quarterly growth, this is a good place to start. Now, if I look here, the market cap on these is 271 billion for something like for AbbVie, but some of these are actually quite smaller, 51 billion with 3M, 129 billion with UPS. Now, I actually have linked down here a dividend calculator, and this is a quick and easy way to understand how much money you will get from a dividend. So if you say the stock price, let's actually go back to AbbVie, and let's say it's $153. I own 100 shares. I've got 15,300 invested. Now my holding period, let's say I want to hold for 20 years, and the annual dividend in this case for AbbVie is 5.92. So let's just look and say 5.92. The dividend tax rate, that'll actually depend on where you think you'll fall. So if you're selling shorter, then it's probably going to be higher. If you're a long-term investor, their tax rates tend to be much lower. Expected rise in dividend payout. I expect the dividend to rise for something like this, 15% a year. And the stock price, I think, will rise 9%. Dividend reinvestment, again, we've talked about this before, but this is, are we actually taking that income every quarter and using it and cashing it out to do something, maybe buy a home, pay for expenses, or are we just gonna drip and do dividend reinvestment plan and go through that? So I'm gonna say we're gonna reinvest, and let's calculate. Now, my ending balance here at the end of 20 years with a 5.92% yield with an annual contribution of $1,000, which is only $81 a month as an annual contribution, this actually turns out to be $10,291,000 with a return of $29,000, dividend income $11,267,000, and then you can actually look at the payment schedule. So my first year, I own 100 shares. My stock price is 153. Year-end dividend after taxes is 885, and my final balance ends up being 18,446. Now, again, because I'm doing a dividend reinvestment, that's why this ends up snowballing so fast. Is I own the original 100. I just keep rolling those shares that they pay me back into my original, back into the principal, and that's how the snowball effect takes hold. So what started as 100 after 20 years will actually be 7,242 shares at the end of 20. And look, you look at this in year 19 going into 20, I go from 4,300 shares into 7,200 shares in 1 year. I double my investment the last year, but you actually have to get it started and get it going for it to take off. And that's typically the toughest part for most people. Okay, now for those of you that don't understand what the concept of a payout ratio and a dividend yield and the debt that a company has, you can actually go straight to Google and look at something like this. So if you want to look at payout ratio, the dividend payout ratio can be calculated by taking the yearly dividend per share and dividing it by the earnings per share, or you could use dividend divided by net income. Very easy. And you can find this info on any, I'm on Yahoo right now. If you click on the stock, you can actually go through and you can see, in this case, they'll tell you the dividend right here, 5.92 or 3.83% is the yield. And it'll actually tell you when the next dividend is, dividend date, October 12th. And again, this is all found when you go under financials. If you look at any of these stocks, you'll actually be able to see the things like gross profit, operating income, net income, which is right here. And this goes back a few years. So if you want to do all the calculations manually, you can. I recommend looking at the summary, looking at what are called forward dividend and yield, looking at when it's paid out, looking at the PE ratio and the earnings per share. You can obviously comb through 10Ks if it's a publicly traded company and see what their debt looks like. But it's a really good indication if you see a high dividend yield and a high payout ratio. If I go back to my original list here, all these stocks are over a 40-year time horizon with a high payout ratio and low debt. This list is generally not exhaustive, but it's a good place to start. The final thing I wanted to look at this is an article from the Motley Fool, which I'm going to link down below. This was an article that came out August 15th, so last month, and they actually go through and talk about reliable dividends, the dividend kings that they call them, and why. I'm going to walk through this as well. So Procter & Gamble, if you think like Crest, Bounty, a lot of the things in your house that you use as consumer staples, that's who Procter & Gamble is. They make a lot of those. Now, if you're looking at dividends here, they have an impressive 67-year streak of dividend increases. Now, my list was only 40, but if you want to really go back at 67 years of dividends, that's astonishing that they've been able to do that. Again, probably not going to be a Tesla, an Nvidia, a Google, a Palantir in terms of the overall returns, but if you're looking for steady growth from a dividend perspective, Procter & Gamble could really be it. The second one is Federal Realty. They have a 56-year streak of annual dividend increases. One of the biggest reasons is they're the only REIT on the Dividend King list, and it's the longest dividend streak of any REIT out there. So my list did not have any REITs on it, but Federal Realty is one. The yield here is 4.72, and I should note that the yield up here is 2.50 for Procter & Gamble, and that's continued to go up. And the last one is Black Hills, 4.4%, and I believe they have a 53-year streak of increased dividends. If you go down here and you look, usually the safest one is a stock or a ETF that has, again, had consistent growth, consistent yield, low debt, and they're continually upping their dividend at least yearly, if not quarterly. So final thoughts, what do you think about this? What do you think of my list? Look at this dividend rocket fuel that I called it. I'll link it down below. What would you add? What are you investing in? But as always, don't forget to design your financial freedom. Take care. Bye-bye.